Hey, everybody. Welcome to another episode of the Everyday Trader. This is Greg from Options Animal. Good to be with you again. Joined by my friend and compatriot, Mr. Hale.
Mr. Hale, that's my dad.
Oh,
My neighbor's kids actually call me Mr. Hale. This is Eric Hale with Trader Oasis. And so Greg and I are here checking in with you just to give you a quick update on what's happening on the markets, take a look at some of the stories that are moving headlines or moving prices today, and talk a little bit about what we're looking at, what's coming up. I think the first thing is, where's the market going today? We're finishing off September, which is always an interesting day. The last day of a quarter is always an interesting day in the markets. And we started off the day pretty bullish, and we're heading down. Let me share the screen here. This is Wall Street Journal. And as we started off with a nice move up, that's where we are currently. And we're grinding down throughout the day. So here's a longer term chart from stockcharts.com. We've had a bounce over the past 3 days. So Wednesday we had a nice turnaround. What had been previously a couple of weeks of a very bearish move, and then a bounce up today. We had some big news today, Greg, or some updates on some economic information. What are your thoughts on that?
well, the PCE number was a little bit light of expectation, which I suppose is a good thing for the markets. Seeing inflation come in a little less than expected. I think the problem the markets are dealing with right now, this bearish move that's happened the last couple of weeks, and we can jump into PCE too. I just want to give you my big picture take. I think part of what's going on right now is seasonality. Markets in September have been really bad. Historically, they're bad. We're going to finish September off on a bad note. I think that just wants to do it. But I think there's also just a lot of other economic factors, big picture factors that are dragging on investor sentiment right now. And whether that's, things like the UAW strike right now that's going on, that now they're talking about expanding it to more plants, that's impacting sentiment in the market. You've got this looming government shutdown again. You've got things like student loan repayment that's happening soon. The market is maybe finally believing the Fed on the fact that they're going to maintain rates higher for longer. So I think you add in all of those. I don't think any one of them is necessarily something that you can point a finger at that says this is why the markets are lower today. I just don't think there's any optimism to push markets higher, including, like I said, to begin with, the fact that we're in September, October, which is the time of year that the markets like to sell off. So the question is how long is it going to go? Are we going to go down to 4,200 and test the longer term 200-day moving average? Or are we going to go back to some levels that we saw earlier in the spring and go clear down to 4,100? I don't know. I think without more guidance from the Fed, because I still believe that's the biggest story out there, is the Fed's stance on interest rates and the longer term impact that's having on both the consumer, the borrower who's borrowing at higher rates, as well as just the repricing of risk assets that's happening because the Fed's higher for longer. I think all those things play in. And unless we get a Fed that changes stance because maybe we get some favorable inflation data, then I think the markets maybe have a hard row in front of them. What are your thoughts?
This 200-day moving average was something that earlier in the week, everybody looks like we were heading straight for it. I don't know. I don't know. I look at this and it doesn't seem like it's support or trend line anywhere here, at least on this index, but it's a critical level that does get a lot of attention. We let off talking about the headline today with the news release of the personal income and outlays in the PCE index increasing 0.4%. It's not as bad as was forecasted. Now, the PCE does not get as much attention as the CPI index. Part of the reason is that CPI is what I think Treasuries, the U.S. Treasury uses. Not, I don't think, I know that they use it for like inflation adjusted Treasuries, the tips. That so CPI gets a lot of attention from the market, but the Fed cares the most about this release. But it was kind of a yawner. I mean, it was nothing burger, as we've said before, use that term. This is showing where the probabilities, this is the FedWatch tool that shows us the probabilities of where we will be in December. We can pick different time frames, but you really need to go out past June before you see us. The most probable is still in June. We're showing no rate hikes until maybe in July. That's the first month. Actually, no, not even July. It's changing as we go through this. So maybe we're pricing in a rate cut in September, it looks like. And if you look at today, what happened today in terms of changes in the numbers, there really wasn't much of a shift. This dark blue line is where it is today. This is where it was yesterday. So we get a slight shift yesterday to today that we're going to stay where the Fed is in terms of not raising rates. So today's news did not really have a big move. I've seen press releases, economic reports that have had really big impact on this FedWatch tool. And again, I'll caution people about these probabilities. To me, it's not so much about the probability, it's about the change in the probability. These are notoriously wrong. And I watch this quite frequently. And the reason I use this tool, and again, just so everybody's aware, this is CME's FedWatch tool. Just do a Google search for FedWatch. And what we're looking at is the changes. So what happened, where was it yesterday or a week ago or a month ago, and where is it today? That's how you can analyze if the news today was significant. So some economic report came out and people will say or make some sort of assessment on, oh, this is going to affect the Fed. You can go here and see, does the market really believe that this will affect the Fed? And you and I know that this is not necessarily connected to what the Fed thinks or says. But it's a market's perception of what the Fed, and I think the Fed has finally built the credibility that, yeah, we're going to be higher for longer. And that's what the market's finally catching up to that. You mentioned that the credibility of the Fed, and that's where we're going to be higher for longer seems to be the narrative here.
And I think something to add to that, Eric, is, like today, for example, the New York Fed president, John Williams, was speaking at an event in Long Island, and he came out and said that he thinks that we're either at or near peak rates, which I think I agree with. I don't know that they're going to raise much more, even if inflation is still sticky, because they can remain restrictive on policy without having to raise rates anymore. And I think that's one of the things that I think the Fed has let me rewind. It's something the market has been mispriced on for a while. The fixation has been so much about the Fed funds rate and the quarter of a point or a half a point. What's the peak rate? And that's all important. But where I think the market has made a mistake is they think that just because the Fed is done raising rates, that they're not restrictive in their monetary policy. One of the things that's going on in the background right now that doesn't get a lot of press is their balance sheet reduction that they're doing. So they're actively in the bond market right now, selling bonds, all the assets that they accumulated through COVID and even prior to COVID, but definitely since COVID, when the Fed's balance sheet ballooned from 4 trillion to almost 9 trillion, they're letting those bonds either, just expire off of their balance sheet and unwind, or they're actually actively selling them in the marketplace, which is pushing the bond market down, which is causing higher rates, which is restrictive policy for the economy and for companies. And so that's why I think the market maybe is starting to price that in now, is that the Fed is actually wanting to reduce its balance sheet. And so even though they may not be raising rates anymore, that doesn't necessarily mean that the market's going to jump up and go bullish because the Fed's done. In fact, I'd even make an argument that the Fed could actually cut rates and still be restrictive potentially through selling assets in their balance sheet. Yeah, here's a good example of what they've been doing throughout the year. Now, put that into perspective. Yeah, exactly. There you go. Put that into perspective. There you go.
Yeah.
They don't want to just be done with just $1 trillion. So going from 9 trillion to 8 trillion, I think the Fed wants to be closer to 4 trillion before COVID.
Yeah.
That's where I think what the Fed's balance sheet wants to look like. In fact, if you remember back in 2018 and 2019, when Fed Chair Powell had just taken over as the Fed chair, he was being restrictive in policy, not by raising rates, but by just reducing the balance sheet. And the market went into a full-on panic. And that's where we had the famous Powell pivot, where he said, okay, we're going to stop selling. And then the market ripped to the upside after he did that. I don't think we'll get a Powell pivot this time. I think this is something that's going to be a continuing headwind for the market, especially if we can maintain the robust economy that we've got going on. So I think we've got a strong economy. I think we've got a strong job market. I think certain sectors are poised as an investment to still do really well. But I think a lot of interest rate sensitive stocks could still face some troubles. I think that the banking sector is the finance sector is one that's unknown right now to me. I have a hard time being bullish there.
Yes. So you mentioned liquidity and what's on the Fed balance sheet. So this is from the Fed's website, it's the same data. This is just money that's floating around out there that needs to go someplace. And I was going to ask you, is it the total level of liquidity that matters, or is it the change? Because I'm people are changing. I'm seeing this, short-term look and saying, oh man, look at the liquidity coming out of here. If you look at a 1-year chart, it's crashing down and the change is huge. But stepping back and looking at this big perspective, we still have a ton of liquidity. What's your thought? Is it the change in liquidity that matters, or the total level of liquidity?
Yes.
Is it both? It's both.
Yes. Okay. It's like I got asked a question on Twitter. Yes, I finally replied today, but I made a comment on somebody's post about the VIX being broken. And somebody had posted something about the VIX doing something weird. And my comment, or I think it was Callie Cox, is who I had replied to her tweet and just said, well, the VIX is broken and it has been for quite a while. And somebody asked me a follow-up question is, well, is that because of it, overuse, or because of shorter duration options? And my answer was yes. So to your liquidity question, is it the direction of the liquidity or the overall amount? Yes, both. The direction, I think, has a negative impact, but there is still a lot of liquidity out there based on the overall amount. But as it comes down, can definitely put bearish pressure as well.
Well, this is the Fed balance sheet. We can see where securities held and what they have. You can dive into it and see what they own. And Greg mentioned that they have a lot of bonds. So they have a lot of treasury bonds. They also have a lot of mortgages. And that's probably another topic to dive into, and what's on the balance sheet and what's coming off the balance sheet.
We need to get back together with Waller, because I want to talk to him about mortgages again. I remember the last time we brought that up with him, he was very adamant about, no, we're not touching mortgages. We won't do anything with those.
All right. Well,
Bahamas, right?
We might have a chance to
February.
I don't know when it is. It hasn't been announced yet. So, well,
I was thinking it was February.
That's probably in
February is a good time to go to the Bahamas.
Yeah, for sure. That'll be a fun time. So anyway, so we got the CPI. We kind of took this conversation a little bit down a rabbit hole. Again, it goes back to, why are we talking about this? Why is it important? The Fed policy has a dramatic impact on treasuries and on inflation or interest rates that affects everything from mortgages to businesses. And I mean, it just has such a dramatic impact across the board. So this is why we look at Fed monetary policy. And we shared in the last episode what happens when the Fed stops raising rates. If we're not in a recession, it's a good thing. The market tends to go higher. If we are in a recession, it goes lower. We can probably share the same research when the Fed starts cutting rates. Everybody is looking for a cut. Don't be careful what you wish for. The market has never done well when we are cutting rates. So we keep an eye on this because it does help us with our forecast. So dialing things back to where we are today, I think a big important thing to keep in mind is this is the end of a quarter, and we get the term window dressing, right? So what's window dressing, Greg?
Well, window dressing is when portfolio managers have to make their window look good, right? You know, what's their window? It's the reporting they have to send out at the end of every month, or in many cases, the end of every quarter is even the bigger one, that they have to send out to all their investors of here's what we own in our portfolio. So that when that disclosure happens, you know, portfolio managers maybe want to make their portfolio look a little bit better. Look, oh, we're in Apple, we're in Google, or whatever it is they want to look like they hold. Maybe it's a
Eli
drug
Lilly,
manufacturer,
or not
energy.
an Eli Lilly, or in Costco. So this happens, and this is an interesting sort of phenomena that happens that moves markets, which is beyond macro. This is traders trading. I mean, it's the end of the quarter, and there's some positions that just have to be closed. And we're also getting into this other part of what happens towards the end of the years, is due to taxes. You start seeing tax loss harvesting, where people will sell losers and sometimes even cut their winners to be able to pay for their taxes. So we get some really weird things that happen in the markets towards the end of a quarter. This is in one of the 4 quarterly ends. So I'm not putting a lot of faith into it, but into what today's signal means. Is this related to it's certainly the biggest news was the PCE, and I contend, based on the change in the CME and the way the market responded, this isn't bad news. I think what we're seeing now is more a combination of tax loss harvesting and the end of a quarter window dressing, what's driving the markets right now. And by the way, if you went back and to our August episode, we talked about this. We said this was going to be a bad month, and going forward, October, we're getting into a period with a lot of volatility. October is the most volatile month of the year. So Greg, I don't know if you still feel the same way, but you mentioned the words that we could see a tear your face off rally. I'm of the mindset that I don't think we're going to go very bearish, but I do expect a lot of volatility in October. You still feel?
Yeah, no, I do too. No, I'm still of the same opinion. I think we could have downside moves still in October, and maybe a really volatile one in October. I think the rip your face off rallies at the end of the year, okay. November, December.
Mm-hmm. Okay.
I'm not positioned bullishly yet. In fact, I was just looking at my portfolio this morning. I just closed 2 more positions this morning. I'm in like 75% cash right now.
And that's a lot for you. Yeah, I think I'm pretty close to about 50% cash myself, which is, I've got a lot of cash sitting around to put to work if I need to use it. We did have a couple of individual stories that I think are interesting. Nike had earnings, which were honestly not that good, but they weren't that bad either. So I think the stage was set for a disappointment, and they were good. What's resonating is the stronger consumer, and we're seeing that not just in companies like Nike, but Costco and HB Fuller and Carnival all have had earnings recently and have noted that they've been able to at least maintain margins. So maybe revenue's not going up with those companies, but margins have been able to improve. I traded Nike, which is I'm doing really well in the trade right now. So this is a bigger move than I actually expected, but I placed a trade that I shared earlier with our community, and it's playing out pretty well. Any thoughts on any of the stock stories that are out there? I mean, there's another area that's related to vehicles and oil, but sticking with any of the retail companies, was there anything?
I actually was pretty optimistic after looking at Costco's report, even though the market has been kind of mixed on it. I mean, it had its jump up initially. It's since sold off. But I'm optimistic that the consumer, at least Costco's consumer, is still pretty resilient. They still have money. They're still shopping. Most of the economy is driven by the consumer, 70 to 75% usually. And so that's why when everybody got helicopter money deposited into their account back in 2020 and 2021, that's why the economy rebounded. That's why earnings have been so great. That's why the market was fantastic. They've held on. They're still pretty resilient, according to a lot of these retailers. So will that continue? That's, I guess, the big magic question. You know, will Costco's earnings be okay? Will Nike be okay once student loan repayments start in full force?
Yeah, I actually I would be worried more about Nike being impacted than Costco. I think
Yeah, me too.
The Costco consumer, I think the average income is something like 96,000 a year. It's a very high, above average. They have an interesting demographic. There was some news that came out after earnings that I caught my eye, and that is that Costco is going to start offering healthcare to members. So $29 for a virtual visit, 72 for in-person checkups, and 79 for therapy visits. So this is a new area that Costco is going into, and certainly with healthcare costs, being a concern for everybody, this is an interesting move. I think the whole healthcare space is about ready to just, well, it's very at risk for some serious what's the word, disruption, I think. So Costco could be disrupting the typical healthcare provider. There's some other companies that I mentioned earlier. I talked about Lilly and Novo Nordisk being, I didn't mention Novo Nordisk, but these companies here have these new weight loss drugs, the Ozempic and Wegovy, and then Tirzepatide or something. There's these new GLP-1 inhibitors are really, I mean, it's been getting a lot of attention. You can see this Eli Lilly chart, and wishing that I got into it when it's in 300s. But I was talking with an MD this week. I mean, it's not unreasonable to see this stock at $1,000 or $2,000 at some point in the future. Doesn't look so good over the past few weeks. And I'm not saying it's going to go there anytime soon. And the PE ratio is very high right now. But the prospects for these weight loss drugs is just insane. So Barron's did a piece over the weekend talking about the drug companies or the insurance companies right now won't pay for obesity drugs because it's a, quote, lifestyle choice. But one of the drugs that Eli Lilly has is under trials right now for sleep apnea. And if I have a CPAP machine and I freaking hate it, and I'm eligible for this new surgery where they put something like have you heard about this? A pacemaker in you? Yeah.
No.
It can detect you mounts in your chest, and like you use like the Apple Watch charger to charge it up, and you don't have to charge it all the time, but it stimulates the back of your throat when you snore. And I have a phone call from my doctor saying, "Hey, you're eligible for the surgery. Do you want it?" I'm like, freaking no way. She's like, "Well, I know you're not using your CPAP machine, and you got sleep apnea." So I've lost weight. My sleep apnea has gotten better. My Apple Watch, which by the way is broken, and I'm feeling naked.
How'd you do that?
I don't know. I'm pretty rough on my watches. I'm going to get the Ultra though. So
Oh, yeah?
it's getting repaired under Apple Care, and then I'm going to trade it in and get the Ultra. That's because I can get a pretty decent trade-in value for that watch. So as soon as I get it back,
I can't go anywhere with mine either. Without it.
if I leave the house, I'll turn around and go back and get it. We could do a whole week on Apple.
We should. No, I'm just kidding.
So Eli Lilly and Novo Nordisk, I mean, they're definitely on my watch list. And I mean, now's not the time. I mean, look at this. But I don't think the story is not done. I would encourage people, if you're interested, go read this Barron's article. It actually talks about the negative aspects of how this is going to impact insurance companies, because if if the drug gets approval for sleep apnea treatment, I mean, there's millions and millions of people who throw their CPAPs. Oh, well, this is for sleep apnea. And oh, by the way, you're going to lose 20 to 25% of your body weight. That's what people are losing on in a year on these medicines. I don't know what happens when you stop taking them and how does it actually work? But I mean, there are a ton of people who are using this drug. And I mean, it could be, it's a blockbuster. And it's going to impact insurance companies negatively. It's going to have a negative impact. But one could argue in the long run, if there's lower obesity, then there's less other diseases as well. So less heart disease and less cancer and all these other things. So that's interesting. The other one is other companies, like the companies that make the diabetes pumps, so type 2 diabetes drugs and equipment. Those companies are already identifying threats to their future due to these drugs. And a surprising one was Intuitive Surgical has already said that they're seeing a drop in weight loss surgeries because people are opting to take these non-invasive treatments using these once a week injections that you do yourself. I mean, there's something here. I'm not sure where the story's going, but it's on my watch list. I mean, it doesn't look so great over the past couple of weeks, but this looks like an AI chart, doesn't it?
Yeah, it's crazy. I was just looking at a 10-year chart of Lilly. I zoomed out a little bit and I'm like, wow, Lilly has been just as good of an investment as Apple has been for the last 10 years, or Tesla. I mean, you just look at that chart and it's just up and up and up and up.
That's a 5-year chart, not a 10-year, but 10
You
years.
go back 10 years and it's under $40.
If you looked at this, I mean, if you've had some of these pullbacks, you might say, oh, that's an opportunity right there. But you can see these periods where it goes, I mean, from a technical standpoint, that's, if you were, oh, I wish I could have bought here. I wish I could have bought here. And the reality is, that's what's going on right now. I mean, how much lower could it go lower? I mean, sure. But this trend has been incredible. I think Eli Lilly has the better pipeline of drugs, according to the MD that I talked to this week, who's an actual surgeon. So he's very deep into this area. They have a better pipeline. They have other drugs that are coming out and other uses. I'm not recommending it. No recommendation to buy or sell security here. Everything's for informational use only, right? But it's on my watch list.
Okay, my friend. Well, it's good being with you again. Thanks everybody for tuning in. Anything else you wanted to talk about before we wrap it up?
Well, let's not give away too much, but next week, I think we've got a special guest who's going to come on. We've got somebody who's a former options market maker who's, we're going to have a good discussion with him about how market making works and what retail traders really need to know about that. And I think you'll all learn something. So if anybody has any questions that you would ask a market maker, if you've listened all the way to the end of this episode and you're thinking, I always wanted to ask a market maker, post the questions down below. We'll take a look at those questions and maybe put them up in this episode. So look for it. That episode will be happening sometime next week.
Okay. Thanks everybody for joining us. Look forward to seeing you another one. And again, don't forget to share with your friends and like and subscribe. Thanks everybody.
Take care.